Hello everyone, good morning to you. My name is Noelle O Connell and I am the Executive Director of European Movement Ireland. I'm delighted to welcome you all, our corporate members and stakeholders, to European Movement Ireland's webinar today on the European Investment Bank, investing and supporting business in Ireland during and post COVID-19. We're delighted to have virtually a full house for today's webinar, featuring a keynote address and panel discussion with EIB Vice President Andrew McDowell in conversation with EM Ireland Chairman Maurice Pratt, followed by a Q&A panel discussion with yourself, our online audience. As you may know, European Movement Ireland is Ireland's longest established not-for-profit voluntary membership organisation that has been working to develop the connection between Ireland and Europe since 1954. We are very much a non-partisan bridge between Ireland and Europe that works to increase awareness and understanding of European and engagement with European issues amongst all sectors and people in Ireland, and to ensure that the Irish perspective on all things Europe and European related is inputted at all levels, institutions, bodies across the EU and across Europe. Today's webinar is the fourth in the series of policy webinars, actually, that we have done since the 13th of March. It has included our annual Red Sea, Ireland and the EU poll, with a webinar featuring Dr. Katie Hayward from Queen's University in Belfast and RTE's Europe editor, Tony Connolly. We have had interviews with the European Court of Auditors Irish member, Tony Murphy, and our Just the Chats podcast has included our latest podcast guests, Lord David Putnam and Claire Hanna MP. I would encourage you all, if you haven't already, to make sure to follow us across all our social media channels and to make sure you're subscribed and registered with us to ensure access to our Just the Facts policy briefings and our CEO briefing insights, to get insights and all developments access on Brexit and EU developments as an exclusive service to our corporate members. I'm delighted to welcome back our guest speaker today, Andrew McDowell, to an event with us. Previously an economic advisor to former Taoiseach Enda Kenny. In his current role as Vice President of the EIB, Andrew is responsible for oversight in multiple areas of the EIB's operations, including funding and treasury, financing, energy, evaluation and impact assessment, and the EIB's Western Balkans investment framework. And if that wasn't enough, he's also responsible for the day-to-day operations of the EIB itself as one of the 9 members of its executive body. And in supporting business and the economy, the EIB has a crucial role to play, not least as it has to date since its foundation financed over 330 projects throughout Ireland and has invested €17.5 billion in sectors here such as education, health, agriculture, energy, transport, and so on. So I think Andrew's comments and his insights today will be particularly important as business in Ireland looks to navigate a recovery post-COVID. I think the first event that we did with Andrew with the EIB was back in Chartered Accountants House, a day or two after, I think, Andrew, you were first appointed. So we're delighted to welcome you here today to another event with European Movement Ireland, albeit one that is done virtually and remotely with you in Luxembourg. And at that stage, when you spoke to us in Chartered Accountants House, I think the word Corona was more commonly associated with the band or with the beverage. A lot has changed since then, but hopefully as we reach phase 1 today of the restrictions lifting in Ireland, we look forward to a phased recovery for the unprecedented challenges that are going to be facing all sectors of the Irish economy and all businesses here in Ireland. And in that regard, the support and investment of the EIB is going to be crucial in getting the country back on track. So in terms of our running order for today's webinar, Andrew will deliver some opening remarks. European Movement Ireland Chairman Maurice Pratt will then have a discussion with Andrew. That will give you all, our online members and stakeholders, an opportunity to get your questions into Andrew and Maurice via the Q&A function on Zoom. After their conversation, I'll then collate the questions and divvy them out accordingly, and we will have you all on your way before 1 o'clock. So our panel of speakers today are located in Dublin and in Luxembourg. The production team is in Cork Wicklow and in Dublin. But first I will, a little bit like the Eurovision, Andrew, we'll turn to you first and go over to Luxembourg and invite you to deliver your opening remarks. Thank you.
Thank you very much, Noelle, and greetings from Luxembourg. Can you hear me okay?
Yes.
Well, greetings from Luxembourg, where we're celebrating today the reopening of the Luxembourg-German border, which is just down the road from me here. And we spent the last 2 months locked down here like everybody else, but in Luxembourg, when you're locked down, when they close the airport and they close the French, German and Belgian borders, it really feels like a lockdown. So we're very excited that we can now travel across the border to Trier. And apparently, you know, we could even go to a bar or restaurant in Trier now if rumor is correct. The French and Belgian borders are still closed, so as is the airport. So our only route of escape is now through Germany. I'm very grateful for the invitation to speak to one of your webinars. So thank you to yourself and Maurice for this event. I've always been a big fan of the European movement in Ireland, a big supporter. I think you've done a fantastic job over the last 60 years in strengthening, obviously, you know, the engagement between Ireland and the European, the process of European integration, and ensuring Ireland is always well recognized as having a high level of awareness and in some ways a sophistication when it comes to understanding European matters. And I think your organization has played a very crucial role in that. And of course, we can never take that for granted, and we can never take those links for granted. I think even you mentioned your poll, and I understand, I mean, obviously support for the European Union in Ireland is still exceptionally strong, but there was a bit of a drop. And it just shows, in the context of Brexit and in the context of COVID-19, we should never take these things for granted. And it's an ongoing challenge to maintain the strength of those links. I'm very conscious as well that many of the people participating today are from organizations, industry, and so on that are supporting the European movement. And I certainly would like to acknowledge, obviously, the value of that support. I was going to speak just maybe for about 10 minutes, Noelle and Maurice, if that's okay, with a brief reintroduction, if you like, to the IB, who we are, what we do. Talk a little bit, pulling back from the IB, about the EU's overall economic response to the crisis so far. And what have been the good parts, what have been the less good parts of the response so far. Turn a little bit then to the IB in Ireland. So in terms of our own response to the crisis and some of the new instruments we're deploying, how can they specifically help Irish businesses? And then finally, maybe look ahead to kind of what's next beyond the crisis response. What are the implications of some of the recent developments for the longer term development of the Union? I mean, just first of all on the EIB, and I can be brief because I think many of you would be reasonably familiar with who the EIB is. But I mean, obviously we're the bank of the European Union, owned by and for the benefit of the 27, still getting used to the 27 member states. Obviously the UK exited our shareholding at the end of January, unfortunately. We're a Treaty of Rome institution, founded all the way back in 1958. Based in Luxembourg with about 4,000 staff here, but with offices all over the Union and indeed all over the world. And our mission is fairly straightforward. It's to finance investment projects, capital formation that support the goals of the European Union. I mean, those goals have evolved over time, you know, from all the way back, you know, in the 1960s when we were, you know, a major part of our work was, you know, bringing southern Italy up to the living standards of the other, you know, 6 founding member states, all the way through, you know, to the 80s and 90s when a big part of the agenda was the single market agenda and infrastructure connectivity and physically linking the member states through road, rail, airports, telecommunications, you know, energy networks and so on, into the first decade of this century when enlargement became one of our major priorities and a lot of our business shifted eastward. Again, trying to bring the newer member states into line with the regulatory and environmental requirements of the Union, and indeed trying to bring their economies, the productivity levels and technological standards of their economies into line with the rest of the Union. The last decade, a lot of it being about the response to the financial and then the sovereign debt crisis, with a major expansion of our activity in both sovereign lending as well as higher risk corporate financing, to a point where we got to last year where it was we were really shifting the business towards climate and environmental financing. So we were moving on from the banking and financial crisis to looking at the environmental crisis as the kind of driving force of the IB business. But of course, we've had to look again at our priorities and turn our business plans on their head over the last 8 weeks in response to the COVID-19 crisis, and I'll come back to that. We are, in fact, and it's not often well known, we are the largest multilateral financier in the world, with a balance sheet of about not far off 600 billion, which means we're about twice as big as the World Bank. It's a slightly unfair comparison in that about 90% of our business is still within the European Union, and that means we're often coming in late stage when projects have already been well developed, well prepared, and we are coming in with putting the financing package together again. Of course, when you're working outside of the European Union, which is about 10% of our business and growing, life is more difficult. You're not just financing projects, you're often rolling your sleeves up and helping to actually design, prepare, and implement projects as well because of local capacity shortages. But nonetheless, I think it gives a sense of the scale of the institution. We do about 70 to 80 billion of new financing every year, again, which is about twice the size of the World Bank. And again, in recent years, we've become the largest climate financier in the world, and really have made a lot of efforts into setting the standards in terms of what climate financing actually means. And again, I might come back to that. As I've said, we're about 4,000 staff. Our business model is quite straightforward. I mean, we are not for profit. We do have to be commercially and financially self-sustainable, though. So the projects we finance have to be bankable and earn us a reasonable financial return commensurate with the risk we're taking. But what we're really looking for is projects that have a big economic impact and where we can make a difference, where we can be additional to the private sector and complement private sector financing. I mean, most of our our traditional product at the IB is long-term debt, senior debt for both sovereign project promoters, big infrastructure deliverers, the Lewis, and so on, the motorways, environmental infrastructure, waste and water infrastructure, and so on. But increasingly, we're also lending directly to the private sector for research and innovation projects. And again, I can come back to many of the projects we're doing here in Ireland under that heading. We also obviously finance PPPs and special purpose vehicles for project finance, for dedicated project finance, particularly in renewable energy. Our direct lending is for rather large projects. So when we lend directly, we're talking about projects of kind of at least 20 million in size, with loans from the IB of at least 10 million. That doesn't mean smaller businesses are ineligible for the IB, but when we work or lend to smaller businesses, it's intermediated through other financial intermediaries like local banks or national promotional institutions. So we lend frequently to commercial banks who on-lend with the benefit of our low interest rates and long tenors onto smaller businesses. And occasionally we risk share with those local intermediaries as well. In other words, we take we guarantee those loans for the local intermediaries up to a certain point to provide the banks with capital relief and better pricing. We also provide some equity, some directly in the form of venture debt products to high growth, highly innovative European businesses that aren't yet bankable, where we provide financing that's contractually in loan format, but taking equity risk on those businesses. In other words, they'll only repay them if the products that they're developing actually work commercially. And we provide equity indirectly through venture capital and private equity funds. So most of the VC system in Europe, most of the big VC funds in life sciences or ICT are dependent on EI group financing through our subsidiary, the European Investment Fund. a word about the EIB in Ireland. Obviously, Ireland has been a shareholder in the EIB, as is compulsory once you join the European Union since 1973. So Ireland took actually a relatively small, if I might say so, shareholding. About 0.5% of the share capital of the EIB is owned by Ireland. I'm often speaking with my colleagues in the Department of Finance about strengthening that shareholding over time, to bring it more into line now with Ireland's bigger role. But that simply reflected the much smaller share of the Irish economy in the European Union when Ireland joined. In the bank, Ireland shares a constituency with Denmark, Greece, and Romania. And what this means is that on the management committee of the bank, where I'm a member, there's 9 members of the management committee, and the large member states, Italy, France, and Germany, previously the UK also, have a permanent member of the management committee. The rest of the countries form constituencies where they rotate the right to appoint a member of that management committee. And 4 years ago, obviously, it was Ireland's turn, and the government launched a competition, and I applied and was subsequently nominated by Ireland on behalf of our constituency to be a member of that management committee. The directors, the non-executive directors of the bank on the board of directors are Des Carville in the Department of Finance, and Des O'Leary has recently been appointed an alternate. We've done about, I think the figure you quoted, Noelle, was 17.5 billion of financing in Ireland since Ireland joined. Actually, I can update that. It's now 19 billion to incorporate the 2019 figures, which we released fairly recently. In fact, last year, we did about 1.1 billion of new commitments in Ireland, which was our biggest year ever in Ireland. We supported 13 new investments in housing. The Housing Finance Agency is a big client of Ireland. We did the first ever housing public-private partnership anywhere in Europe in Ireland last year, in fact. Big loans to the DAA, universities, agribusiness, some more climate action financing. We did some regional development, SMEs, corporate innovation. So a lovely, lovely mix of business. Over time, we've moved away from just financing the Irish sovereign, particularly as interest rates for Ireland have come down through the NTMA, into a broader mix of public and private sector business, which is very nice. I'll turn just briefly, before coming back to how we can support kind of Irish businesses during these crisis times, just briefly on the broader EU response to COVID-19. I mean, I think the first thing to say is, I think we all need to acknowledge, the member states themselves have been the first line of defense in the economic response to COVID-19, in response to the shutdown. I mean, by contrast with the United States, for example, it's been the member states in Europe that have put on the table the vast majority of economic measures to obviously keep businesses alive through guarantee mechanisms, to support their health systems, obviously, to put in place new transfer systems to keep workers paid during the crisis and to support the most vulnerable and support the unemployed. I think it's fair to say, there has been some criticism of the EU that it's been very passive in that regard, compared to the US, government and federal initiatives. But I think what's been important and what's not been so recognized is the EU in some ways had to accommodate that, had to let that happen, had to get out of the way in some respects to allow the member states to play that first line of response role. So for example, obviously the state aid regime needed to be adapted, and this new temporary state aid framework has been put in place to allow the member states to support businesses, to put in place guarantee mechanisms and other direct supports for businesses, tax deferrals, local authority deferrals. All of these have to be accommodated under the EU state aid regime and single market regime. The same goes for obviously public spending. I mean, the levels of public spending that have been committed to are obviously way beyond what's envisaged in the Stability and Growth Pact. And obviously that needed to be suspended as well through this escape clause in the Stability and Growth Pact to allow the member states to inject emergency levels of public expenditures into the economy. So I think, I think there would have been a lot more criticism of the European Union if it hadn't gotten out of the way and allowed the member states to quickly react to emerging economic circumstances. But I also think it hasn't just been about getting out of the way. There has been a very somewhat quiet and uncelebrated, but extremely important set of instruments put in place to make sure the economic shock, the shock to the real economy, did not spiral into a financial crisis so far. I mean, we'll all recall 10 years ago what happens to us when we have a severe banking crisis and wider financial crisis, including in the sovereign debt markets. This has not happened so far, despite the fact that the real economy is suffering a much bigger shock than happened 10, 12 years ago. In some ways, this has been kind of the dog that hasn't barked yet, and nobody has noticed it. But it is because of the institutions and policies that were put in place over the last 10 years. So, for example, the European Central Bank has responded in a very different way compared to 10 years ago, obviously with its asset purchase programs, with its targeted refinancing operations for businesses and so on. And we can get into technical detail if you wish, but it's been a very different response. The same for bank supervisors. And don't forget, there was no common supervisory regime for banks in the last crisis. And now we have a single supervisory mechanism for the largest institutions and much better coordination through the SSM and the EBA on things like using capital buffers, that have been built up over the last 10 years, on things like making sure loan loss provisioning in banks isn't done on a very pro-cyclical basis. So basically, what I'm trying to say is that quietly behind the scenes, the work to prevent a banking crisis as a result of what's happening in the real economy has been extremely important. There's also been this liquidity package provided by EU finance ministers and endorsed by the heads of state and government in the last month. So the European Stability Mechanism now has a 240 billion credit line available for the member states to finance health-related expenditures if they want to draw it down. There's another 100 billion liquidity line available from the European Commission for labour market-related interventions if the member states want to draw it down. And from the EIB, there's this 200 billion package underpinned by a 25 billion guarantee fund for businesses. And I'll come to that now, what that means, if the member states want to draw it down. And while these haven't been drawn down yet, they haven't been operationalized yet, I think they have had a confidence effect on the markets, that these credit lines demonstrate the kind of political solidarity that, notwithstanding some of the arguments we're reading about in the newspapers, that there is now enough political solidarity to underpin sufficient liquidity for the markets. And I think that's been extremely important. Just on the EIB proposal for, and I've lost my presentation, on the European Guarantee Fund, I think what we have proposed to put in place and what's been endorsed now by the finance ministers is basically a 25 billion guarantee from the member states to allow the EIB to intervene with banks and national promotional institutions, and to a more limited extent with the equity markets, to support the provision of up to 200 billion of equity from of liquidity for corporates and other SMEs. And the way this is going to work is basically the EIB now has the capacity to provide high-risk guarantees to banks that are now going to be willing to lend to SMEs. So let's remember, the real problem at the moment is not liquidity for banks. There's plentiful access of liquidity from the European Central Bank and indeed other national central banking systems. The markets are also pretty liquid. Saving rates are quite high, so deposit levels have remained very, very robust in banks. The problem for banks is they're looking at their end beneficiary, they're looking at their creditors, and they're going, are they going to be able to repay these loans? How long is this lockdown going to continue? And are they going to be able to repay the loans if we roll over their working capital facilities, if we provide term loans for investment finance, and so on? And what we will do is complement national guarantee schemes to basically provide risk-sharing instruments for the banks that make them much more comfortable at rolling over finance for the private sector. And we're working now with every single member state in the union to work out what the best way is to deploy it in the given local circumstances. Given the type of local interventions that have already been made, how do we leverage those local interventions with EIB support? And so that's one way we'll obviously come in and support local economies with this new guarantee fund. The other is through equity financing. And in fact, it is evident that a lot of particularly smaller and more innovative companies in Europe, they're not bankable in a traditional sense. They don't have access to traditional banking credit facilities. They're just not in that stage of their development. And so we will also provide a significant amount of fresh capital for the European VC market, the private equity market when they're supporting innovative companies, as well as direct venture debt loans for certain companies at a certain stage of development. And the reason behind this is because, one, they don't have access to bank finance, but also we learned from the crisis in 2001, 2002, the dot-com bust, is that if you let the VC market go down, and if you destroy your innovation ecosystem in a crisis like this, it takes about 10 years to rebuild it. That if we want to maintain Europe's technological edge, maintain its technological sovereignty, avoid a situation where the most innovative companies across Europe end up getting sold out in this crisis to the Chinese or to the Americans because they run out of cash, then we need to urgently invest capital in the VC ecosystem in Europe. How will we deploy this in Ireland? I mean, what will this mean for Ireland? Well, the first thing I want to say is we will, to the greatest extent possible, continue with our pre-COVID-19 business plan. So obviously we had, we had a €1 billion business plan in place for Ireland, on the sovereign side, particularly for the health system, in fact, which I think will be very relevant. We have PPPs, we've got other infrastructure projects, we've got projects with the utilities. We'll try and keep all of that going to the greatest extent possible. Unfortunately, there is a lot of infrastructure investments being put off, not just in Ireland, but everywhere, just because of capacity constraints and economic uncertainty. We are, actually, it's interesting, we're seeing a lot of corporates coming to the IB for the first time. Corporates who would not normally have come to the IB, either because they don't have debt in their capital structure, or they just were perfectly okay with their existing banking facilities. And they're coming, some of them are coming to the IB for the first time looking for support. We're obviously talking to the government about the particular schemes being rolled out and how we can support those. So, for example, the new COVID working capital scheme for being rolled out through the SBCI and the commercial banks, which is basically a government guarantee on working capital facilities. This was the Brexit loan scheme. It's been repurposed to be a COVID-19 scheme. We will come in with significant amounts of financing to increase the firepower of that scheme and basically to increase and broaden the eligibility of it to include more types of companies. We're also looking at a 500 million increase in the Future Growth Loan Scheme. This was another scheme that we put in place with the SBCI and the government last year to provide longer-term unsecured finance for businesses that want to invest without having to provide significant amounts of collateral. It was originally intended to be a 300 million scheme, and now we're coming in with an additional potential 500 million of capacity to increase that. And again, the end result of that will be that banks feel much more comfortable lending long-term, again, to companies that still want to invest, even in this environment, and they will not require the same levels of security or collateral. The government is also looking at putting in place a 2 billion credit guarantee scheme for businesses. This was announced by Pascal Donoghue a couple of weeks ago. And again, we're already looking at the details about how we'll counter guarantee that in order to basically maximize its scale and also minimize the impact on the Irish public finances. And then finally, we're talking with the Irish Strategic Investment Fund, who is looking at a new 2 billion pandemic relief fund to provide more equity into the Irish market. And as I mentioned, we have now the capacity under our own guarantee fund to do significant equity supports for the local innovation ecosystem. So in the end, I hope we're able to top up a lot of the investments we've made in the Irish VC funds in order to make sure their end beneficiaries do not run out of cash during this crisis. Finally, what's next? I mean, where are we going in terms of the European conversation? So we have now the European Commission has accommodated the national responses in terms of state aid and fiscal rules. It has put in place this new crisis liquidity package of 540 billion that I've mentioned, which is fine, but the conversation has already moved on to what's next. I mean, there's a recognition that what we've done is not enough, not nearly enough. There's too much reliance on the ECB and monetary policy. And I think this judgment in Karlsruhe, by the way, at the German Constitutional Court, has just reinforced the vulnerability that Europe feels in relying too much on ECB asset purchases as its only economic response. There's also a lot of concern about the dangers of the asymmetry in the economic impact in national policy responses. And what I mean by that is, with the suspension of fiscal rules and the suspension of state aid, it's the stronger member states who can do an awful lot more to support their economies. So if you look at the state aid statistics, 52% of state aid approvals since the crisis began have gone to German companies. And yet it's in Italy and Spain where there's the worst of the economic impact, because first of all, they got the health situation was worse. And secondly, they're much more reliant on tourism. And obviously the tourism industry is going to be particularly hit. So there's a lot of tension rising between the member states at the danger of a two-speed recovery, that with the suspension of the normal rules, Germany and other stronger member states are going to steal a march on everybody in the recovery. They're going to grab more market share because of the strength of their national supports. There's also recognition that liquidity alone cannot solve the growing national and corporate solvency risks. So it's fine to keep pushing debt out into the market, but when corporates and countries reach a certain point, too much debt becomes dangerous. So you need to look at other tools. So this is why attention is now turning, obviously, to the European budget, in the jargon, the MFF, the medium-term financial framework, and how, for the first time, the budget might be leveraged with borrowing by the European Commission to increase the size of the budget. Now, this would be quite a breakthrough for Europe. Don't forget, the Union has never borrowed to spend. It has borrowed in the past. The Commission has borrowed in the past to lend, including to countries like Ireland in crisis situations, as well as other countries. But it has never borrowed for normal budgetary interventions, for spending programs, for grant programs. Every penny that it spends is raised from the member states or through own resources. Now, because of obviously the crisis economic situation, there's a proposal that the Commission, backed up by the member states, should be allowed to borrow significant amounts of money to front load and leverage the size of the EU budget. So normally the EU budget is about 1.1% of EU GDP. It's pretty small compared to national budgets. And there's now talk about effectively doubling the size of that EU budget by borrowing on the markets. Now, this is going to be, I think this is the right thing to do. I think it's the right economic response by the Union. It is going to be a very, very difficult political discussion. Don't forget, they've already spent the last few years talking about a normal budget for the Union without agreement. The 7-year budget cycle comes to an end this year, and they need a new budget for the end of this year. It was already difficult enough. Now you're adding this new dimension to it, which is doubling the size of the budget through borrowing. And it's going to create an awful lot of questions that need to be solved very quickly by leaders. For example, what is the objective of this additional firepower? Is it just, pure transfers kind of to the most crisis-hit countries? Is it to support the Green Deal, which the kind of greening of the European economy, digitalization, which would get a little bit more support from some of the northern member states? Is it for the cohesion programs where, Central and Eastern Europe would be a little bit more attracted to it? How much are we talking about? I mean, at a conservative end, we're probably talking about something like 300 or 400 billion additional firepower. But of course, others are looking for much, much more. The Spanish have talked about 1.5 trillion on top of the normal budget, which is, is probably more commensurate with the scale of the crisis, but it's going to be very difficult to agree. Exactly for what? Is it going to be for private investment, public investment, guarantees, grants, loans, some mix of the above? Again, all of this is going to be very sensitive, particularly this discussion about the balance between grants and loans. Loans have their own repayment mechanism, but grants need to be repaid. So if you're borrowing to finance grants and normal expenditure programs, how is the union going to repay it? And this is going to bring into focus the issue of new own resources, new revenue sources for the union. There's talk about a digital service or digitalization tax, a kind of digital taxation. There's more talk about more environmental taxes that would go straight to the union, like a plastic bag tax, or plastics levy, on all plastic uses. Obviously, there's more talk about, increasing carbon taxes to pay for it. The financial transactions tax has come back onto the table. It was kind of killed off there last year, but it's now come back again as a way to repay this financing. I think what's crucial about this debate, and very, I think, significant, is this is a kind of, I think, a major moment for the union. I think this is a moment of truth. Will it be a kind of, Hamilton moment for the union, where the union agrees to federalize, perhaps at a small level initially, but agrees that it's going to build a central budget capacity that can borrow on the markets like most governments? Or is it going to be a kind of, a Jefferson moment that never happened in the United States, where we just accept there will be no federal movement in this direction? We're just going to keep this as a confederation, albeit one with a monetary union, which is very difficult to manage. And we've seen the downsides of that. So I think this debate, and it's going to take place in the next few weeks, is going to be a major milestone in the development of our union. And the outcome for this, I think, will set the tone for the European Union for at least the next decade. I'll leave it at that, and happy to answer all questions or comments. Thank you very much, Noelle. Thank you.
Andrew, thank you. That was a tour de force, I have to say. You're entitled to take a glass of water now if you want to before we pass on some questions to you. A couple of observations that occurred to me, and I'm going to focus on just asking you a few questions around Ireland specific in a sense. But the overarching thought I had from listening to you speak is the lack of awareness that there would be, certainly in this country, about the support levels that you have now. You've run through in extremely comprehensive detail. And I suppose, speaking as a marketing person, is the EIB doing enough, and are our government doing enough to actually let people know the extent to which that sort of funding is there and is available, particularly for SMEs, who are in many cases, as we all know, gasping for support just to survive. In terms of questions, just a couple of specifics. First of all, is your business model more push than pull? So do you always have more projects that you're looking at than you actually got capability to finance? How does that work?
Yes, in answer to your question, Maurice, because basically we're cheap and we're long, and in terms of tenors, and so we are more attractive normally than the marketplace. And now the only downside, and I'll be frank about this, the downside of EIB financing, at least particularly for our corporate borrowers, and they'll tell us this, is we're pretty bureaucratic, and we're a public sector institution with all the transparency requirements and all the rest, and so we take a few months to make decisions, and we ask an awful lot of questions of people borrowing from us. Exactly what are they using our money for? Exactly, and we're very attentive to compliance issues and so on. But notwithstanding that, yeah, there's excess demand. So how do we allocate it? Well, we want a reasonable geographic balance in terms of our the overall distribution of our financing. We don't have quotas for countries, by the way. But we do pay attention if no country is getting any projects. That's not a good thing for us. And then after that, it's about impact. So we really are kind of rationing the projects according to where we feel we're making the greatest difference. So, you know, if we see a very attractive project that's very nice, earning a nice return for us, good credit-worthy borrower, but the private sector is happy to finance it on exactly the same terms and the project will be identical, you know, we'll step back and say, look, you know, that's not the purpose of a public institution. Let the private sector do what the private sector does, and we'll step back. So we tend to ration on the basis of where we feel we're really making the most difference to actually strengthening the project or accelerating the project.
Okay. And again, just a specific one about Ireland. So in terms of your knowledge now and experience, what stands out to you in terms of Ireland's area of competence or potential or opportunity that you think we're not doing, you know, what sectors we've actually not, you know, not actually realized the potential of and for?
Where Ireland has been particularly good, I think, in the last 15 years is probably on private financing of infrastructure, public-private partnerships, other forms of project finance. So I think Ireland is at the cutting edge when it comes to project finance, and we've probably done more business on a per capita basis here in Ireland on PPPs than probably anywhere else. Ireland is also very good on the venture capital side. So there's a really, really nice VC ecosystem for life sciences companies, biotech companies, software and other ICT companies in Ireland. Ireland is one of the hotspots in Europe for that type of innovation financing. And I think Enterprise Ireland and ISIF and others have done a great job building that up, and we've been happy to work with them. Where is Ireland a little bit further behind the others? I'd say on housing finance. And, you know, I mean, Ireland has had two models of housing finance. It's either social housing or private housing. And don't forget, in the rest of Europe, they have a kind of a middle tier of housing, which is affordable housing. Now this takes different forms. You know, it can be state-owned, it can be not-for-profits. Sometimes it's even profit-making companies, but they have an affordable housing mechanism where it's not a transfer from the state. It's not charity. It's just a long-term housing finance model that just covers its own costs, and there's no speculation, there's no private gain, and it keeps the rents extremely low, or at least much more affordable, particularly in urban areas. And Ireland just hasn't managed to develop this. Now it's very much part of the previous government's program. Owen Murphy was trying to push this. I hope it's going to be part of the new government program. And I think we could do an awful lot in helping to move that along. Just to say, finally, Mar, I mean, I think your point about awareness, I really agree with. I mean, we're not a marketing, institution. We might need your advice someday on how to brand ourselves a bit better. But if anybody is looking for money, Cormac Murphy is on this call, and Cormac is the head of our Irish operations, based down in the new NTMA building. And the EIB can be a complex organization to access. We're here in Luxembourg. You know, traditionally people didn't want to phone Luxembourg. Somebody might answer in French, kind of thing. And Cormac is on the ground there now with other colleagues, and is happy to navigate entry into the EIB for potential investment promoters seeking financing in Ireland.
Right. Andrew, thanks. That's great. I'm just very conscious of the time, and although I have clatter more questions here I'd like to ask you, I think it's only fair to give those whom I know have questions lined up to put to you, to give them the opportunity to do so. So I'll hand back to Noelle. Noelle's got those, if you can put them to Andrew, and then I'll come back shortly to wrap up. Thank you.
Great. Thanks, Maurice. Thanks, Andrew. So